Hello, Doctor. We are Group 5. This is our presentation of balance sheet analysis for AEON. Next, let's begin with the pattern of cash flow changes. From 2018 to 2019, AEON's cash balance dropped significantly to 66 million ringgit. This decline is preliminary due to long-term debt repayments, as the company reduces debts from 350 million ringgit to 205 million ringgit. Another contributing factor was the sharp rise in the gross property, plant, and equipment, up by over 2.15 billion ringgit, indicating heavy capital investment. In 2020, cash recovered slightly with a 6.6% increase. This rebound was likely driven by increased short-term borrowing, which peaked at 728.5 million ringgit. At the same time, working capital demands were reduced, particularly from lower inventory levels, allowing more cash to remain within the business. However, the most dramatic shift occurred from 2021 to 2022. Cash jumped from 71 million ringgit to 237 million ringgit, a cumulative growth of 266%. This was largely due to several operational and financial optimizations, the repayment of short-term borrowing, reduction in long-term leases, and a sharp decline in capital expenditure. Overall, the company moved from aggressive expansion to consolidation and debt cleanup. So, when did AEON ramp up its borrowing? 2019 was the most aggressive year for debt accumulation. The total borrowing reached 3.22 billion ringgit, a 224% increase compared to the previous years. This was a strategic move to support its expansion. In 2020, while total debt was not as high, short-term borrowing reached its peak at about 729 million ringgit, increased by 26%. However, by 2021, long-term borrowing were cleared off the books, and AEON had new borrowings of around 327 million ringgit. This suggests the company shift from long-term to more flexible financing options before beginning a major deleveraging phase in 2022. AEON actually do with all this borrowed money? Most of the funds were directed into expansion. Firstly, fixed assets investment. Gross PP&E jumped from 5.81 billion ringgit in 2018 to 7.696 billion ringgit in 2019. Meanwhile, construction in progress dropped sharply, suggesting many of their capital projects were completed that year. Secondly, leasing. Long-term leases peaked at 2.15 billion ringgit in 2019, likely tied to new store openings or expanding logistic facilities. However, lease liabilities started to decrease steadily from 2020 onward. Third, working capital. Inventory levels saw the largest annual spike in 2019, consistent with the rollout of new stores or expanded retail operations. However, by 2020, inventory dropped by 17.3% and then remained stable. So next, let's evaluate AEON's credit monitoring system. Does the company have a good credit monitoring systems? In my opinion, my answer is no, because I believe there are two key factors that impacting the system, including accounts receivable, allowance, and the quick ratio. So let's start with the accounts receivable and allowance. In 2020, 2020, AEON dramatically relaxed its payment terms, leading to 71.8% spike in accounts receivable. This boosted short-term sales but also triggered risk. Allowance for doubtful debts reached 25.2 million ringgit that year, the highest in the period. By 2020, the tightened control, bringing AEON down by 30.9%, but the allowance ratio still remained high at 27%. While this shows a more cautious stance, it also reflects reactive management rather than a proactive planning. So now let's look at the quick ratio, which measured cash and receivable against current liabilities. The trend is worrying. The ratio was only 0.17 in 2022. Industry standards suggest a healthy ratio should be above zero point 0.5, and anything below zero point 0.2 falls into a danger zone. Even after repaying short-term debts in 2022, the company's underlying liquidity remains weak. So in short, AEON's credit monitoring lacks proactive controls and long-term consistency. They rely on allowance as a reactive buffer, but have not established a solid balance between sales expansion and cash flow security.
Hi everyone. Today I will be discussing AEON's financial position based on its balance sheet through four key questions. The first question is, did the company make a profit over the years? The answer is yes. While the balance sheet didn't show the profit directly, retained earnings give us a strong hint. AEON's retained earnings dropped sharply in 2019, likely from a net loss or high dividends, but then rose steadily from 940 million ringgit in 2020 to 1,047 million ringgit in 2022. This suggests the company returned to making profits and returned a portion of them. Other signs also point to positive performance. The first one is cash balance. It grew from 71 million ringgit to 237 million ringgit. And next is equity. Equity increased without new share issuance. And then the total debt declined, suggesting profits were used to repay their loans. So while we can't see exact net profit, those clues together show AEON likely rebounded after 2019 and stayed profitable. Then next is the question, what's the impact of asset management on companies' profitability? So let's look at asset management. AEON's inventory stayed stable between 2020 and 2022, which reflects good cost control during a volatile time. This helps avoiding overstocking and improves margins. Accounts receivable also dropped from 93.7 billion ringgit in 2021 to 80.7 million ringgit in 2022, showing better collection efforts and stronger cash flow. And its net property, plant, and equipment declined from 5.4 billion ringgit in 2019 to 4.2 billion ringgit in 2022, which suggests a more cautious approach to investment, helping reduce depreciation and financing cost. Overall, AEON's efficient management of inventory, receivables, and fixed assets likely supported a stronger profitability. Then let's move to question 3. To what extent did changes in working capital affect cash flow? So now to working capital, which is the difference between current assets and liabilities. Ideally, this should be positive, but in AEON's case, it's negative and worsening, which is from minus 921 million ringgit in 2021 to 966 million ringgit in 2022. This means the company had more short-term liabilities than assets, which can pressure cash flow even if the profitability is improving. So high short-term obligations like lease payments and payable might require external financing or limited AEON's flexibility in their spending. And so improving working capital could help free up cash and strengthen day-to-day financial health. Okay, finally, let's talk about liens. The question is, how do changes in liens liabilities affect the company's financial position and reporting practice? So in 2019, we can say that AEON adopted a new accounting standard. That's why the liens liabilities, both current and long-term, suddenly appeared on the balance sheet. So, and also, this made the company look like more leveraged. For example, long-term liabilities were 2.1 billion ringgit in 2019, dropping slowly to 1.6 billion ringgit in 2022. However, this isn't a sign of added debt, just a more current reflection of AEON's liens obligations. It's also added margin right-of use as assets to the balance sheet. In short, those changes improve financial reporting, giving us a more clear picture of long-term commitments, especially important for a retail company like AEON. Finally, in conclusion, AEON showed signs of recovering profitability, managed its assets effectively, faced some cash flow pressure from working capital, and adopted to new liens reporting rules that enhanced transparency. And that's all. Thanks for your listening.